Good morning and welcome to Financial Accounting. As we look at our calendar for today, you can see that we'll be finishing up Chapter 9 today. And so your Chapter 9 exercises should be submitted for grading by the end of the day today. And then the Chapter 9 problem will be due on Thursday. I did schedule a drop-in review session for Financial Accounting for Thursday afternoon again. We'll try that again this week from 2 to 3 p.m. on Zoom. You are welcome to join us. At this point, I already know I'll be talking about the Chapter 9 problem a little bit. And there's been a request to talk about the real world annual report as well, but we'll probably talk about that during class at the end of class today. Excuse me. And so we may answer some of those questions today and then cover any additional questions that come up on Thursday in that class. So Chapter 9 is the final chapter for Exam 3. So you can see looking ahead that the exam and the project 3 should be submitted. The project should be submitted by Sunday, April 3rd, end of the day, and the exam should be taken also by that time. So you can take the exam anytime after you complete all the assignments, Chapter 7, 8, and 9. So the exam is available now. You can take it as soon as you're ready, but after you finish the Chapter 9 problem, please. If we look ahead just a little bit, see where we're going, just to get the view. So we'll be covering Chapter 10, and Wednesday, Chapter 10 is not on the exam, but we'll start Chapter 10 on Wednesday. We'll finish that up next Monday. And you can tell by looking at our calendar that next week is our last week before our spring recess. This spring recess this year is the week leading up to Easter. So Chapter 10 and Chapter 11 are the only chapters for Exam 4. So it seems like Exam 4 comes up much more quickly than usual, even with that week off in between, because we have just 2 chapters. So as you know, 14 chapters we covered this semester. So on the 5 exams, 4 of them cover 3 chapters, but Exam 4 covers only Chapters 10 and 11, which are the 2 chapters on liabilities. All right. So any questions about what's due? Scheduling, anything? If you are able to attend that review session on Thursday afternoon from 2 to 3, or for any part of that, you don't have to be there for the whole time. If you can't come at 2, but you can come at 2:15, or you need to leave at 2:45 or whatever, anything is fine. That's why it's called drop-in review. It's totally optional. And I will record what we do as well, because I know there are some people who can't attend class or review during the day because of work schedules or whatever. And so we'll record that session and make that recording available afterward as well. All right. Last class, we started talking about Chapter 9 on long-term assets. We were focused last class and for the first couple exercises today on property, plant, and equipment, those physical, tangible assets, things you can touch. In order to be long-term, it means that they are going to be used by the company for more than 1 year. And so the tangible assets are subject to depreciation. So we talked about on Wednesday of last week, we talked about how we record the acquisition of those assets, what type of costs would be included in land improvements, and in buildings and equipment and so on. So we looked at an exercise or 2, recording the acquisition or the purchase of assets. And then we have 3 different ways of calculating depreciation. All 3 of those are perfectly acceptable under GAAP. We talked about some of the reasons why companies might choose to use one or the other. And the 3 methods were straight line, production or activity method, where we record the depreciation based on how much we actually use that asset, not just on the passage of time. Excuse me. And then the third approach is the accelerated method, where we front load that depreciation. The one we used is double declining balance, or DDB. So you should be able to calculate depreciation under any one of those three methods if asked. Then we look at what happens if we don't acquire the asset in the first half of the first month of the year. So how do we record that partial year depreciation? As you know, it doesn't change anything if it's a partial year if we're using the production or units of activity method, because that's based on how much we actually used it, not how long, not based on the calendar. So we did a partial year depreciation calculation under straight line and double declining balance here in exercise 4. And then finally, to wrap up our class last Wednesday, we looked at, well, what happens when we base our depreciation on those two assumptions: how long we're going to use the asset, how much it's going to be worth when we're done using it. What happens when one or both of those substantially change? How do we adjust our depreciation for those new estimates? And so that's what we did in exercise 5. And that's where we ended class last week. Does anyone have any questions about any of that? Oh, and I just had another thought. So, excuse me. As we're looking ahead to that exam coming up this weekend, there is a practice set of exercises for that exam. And so in that review session on Thursday, we could go through some of those if there are some that are more troubling. And so if you can attend the review session and have some of those practice exercises you want to include in what we go over in that session, please just let me know. Those practice exercises or the practice set is totally optional, but it is set up based on how the exam is set up or what's on the exam. So I do strongly recommend that you try those, especially ones that you know maybe you found a little bit more challenging when we worked through those chapters. All right, any questions before we move to our new material for today? Go to our PowerPoint then. And our first exercise for today will be exercise 6, and it is on capital versus revenue expenditures. So as in what I just reviewed, we talked about how we capitalize an asset that's a long-term asset that's going to be used for more than one accounting period and more than 1 year. But not every expense related to that asset is a capital expenditure. Not every cost goes on the balance sheet as part of that asset. Some of those costs associated with those assets are going to be what we call revenue expenditures, or simply an expense. So in chapter 1, we learned the term expense. What that means in an accounting sense is it's something that helps us to generate revenues in the current period. And some of the costs associated with these fixed or long-lived or plant assets, property, plant, and equipment, long-term assets, some of those costs are going to go directly to the income statement in the period in which they're incurred, and those are referred to as revenue expenditures or simply an expense. Other costs associated with those assets may actually go on the balance sheet even after we purchase the asset, not in the same period. So 5 years down the road, some costs could go on the balance sheet and be capitalized, or a capital expenditure. So you can see a brief definition here of what is a capital expenditure. It's something that improves the asset. It doesn't mean restoring it to its original condition. This is not routine maintenance. This is not repairing something that was broken or had worn out, but it improves the asset over its original condition, makes it more valuable than it was in the beginning, or extends its useful life. Those would be considered capital expenditures. Those do go on the balance sheet and get written off or recorded as depreciation over that extended period of time. So typically, if something is a routine maintenance or repair to restore something to its original condition, we would record that as a repair and maintenance expense. So it goes right on the income statement in the period in which those costs are incurred. And you can see an example of what that would look like there when we pay for a tune-up or an oil change on our car, changing the filters or whatever. That's routine maintenance. It doesn't extend the life of the asset. It doesn't make it better, more valuable than it was initially. But those capital expenditures are going to be added to the balance sheet. And if it doesn't, let me just show you on the next slide. It'll be easier to just show you what it looks like. So if you think about what we learned last class when we record depreciation, and actually we first learned that back in chapter 3, when we record depreciation, over time it is a debit to the expense and a credit to accumulated depreciation. What we're seeing here is if something is an extraordinary repair, extends the useful life of that asset, you can see that instead of adding to the original value of the asset, we debit the accumulated depreciation on that asset. So instead of increasing the original or historical cost that's in the, in this case, it would be in the forklift line, there'd be an account called forklift. Instead of increasing that, we simply decrease the part of it that's been used up. We debit the accumulated depreciation. So I think at this point we can go to our first exercise. And where is it? There it is. So this first exercise, because it's quite wide, you may need to collapse the listing of all the individual exercises over on the left, as I just needed to do. So you should be able to see to the far right of the descriptions, number 1 through 10, you should be able to see the drop-down list. This is one of those multiple choice type questions. We've got a 50-50 chance of getting it right, even if we don't read what it says. Please don't do that. Totally defeats the purpose of going through this exercise.
Stuff like this is kind of hard to do on Zoom because you gotta have it like on screen so you can see yours and
yeah. Yeah, that's a good point. So for you guys who are on Zoom, you may need to not look at mine, and I'll try to be careful that I say everything out loud as we work through them, because this is such a wide exercise. The only reason I made a point of saying there's a drop-down list over on the right, because I've actually had people with this exercise in an earlier semester email me and say, I don't know what I'm supposed to do with this, because all they could see were the lists 1 through 10. They're like, I don't know what to do. I don't know how to put in my answers. So this one's an odd one for that reason. Jackie Fox owns and operates Platinum Transport Company. During the past year, Jackie incurred the following costs related to an 18-wheel truck. Classify each of the costs as a capital or a revenue expenditure. So we know that revenue expenditures are going to be the routine repairs and maintenance. They don't extend the life of the asset. They don't improve the quality of the asset over its original quality or value. Capital expenditures are going to be those expenditures that do hit the balance sheet because they either improve the quality of the asset over its original value, or they extend the life beyond what it would have been. So let's start with changing the engine oil. What do you think about that one? Is that a capital or a revenue expenditure? Does that actually make the asset more valuable, or does it just keep it in its current condition? So I would say for sure that's a revenue expenditure. That's just part of operating the vehicle. And so it's going to hit the income statement as a repair and maintenance cost in the period in which it's incurred. Install the television in the sleeping compartment of the truck. So we have to make an assumption here. One, we assume that it didn't have a television before. And two, the fact that it says installed, we're assuming that means that it is now a permanent part of the truck. So we didn't just put a television in there, but it is actually a permanent part of the truck. The reason that's important is if it was not a permanent part of the truck, it wouldn't be on our balance sheet considered part of the truck either. So for example, I look at the building where we are right now, all of the assets that are in this classroom, the tables, the computers, those are all long-term assets, but they're not considered part of the building. It's a whole separate category of asset. So if the television, if there was no television before and there's now a television that is a permanent part of the truck, that would be a capital expenditure because it does increase the value.
With the projector you want?
The projector is still considered part of equipment, even though it is kind of installed. I mean, it's easy. I say this. It's easy to take it down. It can be removed. So a built-in dishwasher is still not considered part of a house because it can be removed. And typically might be if the house was sold, if it didn't come with, you weren't selling the appliances with the house. So good question. The question, in case you didn't catch that on Zoom, is about the projector that I use in the classroom, and it is installed, but it can be removed. So it's not a permanent part. They take it down to repair it. It's actually a pretty new projector. Maybe 2 years ago, they replaced the projector that was there and put in a new one. So those are still considered not part of the building. Now the wiring and that kind of thing, the lights are probably considered part of the building. Excuse me, number 3, install the wind deflector on top of the cab to increase fuel mileage. So again, we're assuming there was not one there before, and this is a permanent fixture. There's one other consideration, and we talked about this in class last time, but just to remind you, this wind deflector also would have to reach some value, some level or threshold for materiality. So, if it was $50, they wouldn't bother putting that on the balance sheet. But if it's, as we talked about last class with the recycle bins here in the classroom, yes, they've been around for 20 years, but they're probably a small enough dollar amount that we wouldn't bother to capitalize that. We'd have that same consideration here. Yes, it's technically a capital expenditure, but is it high enough dollar amount to make it worth our time to put it on the balance sheet like that? Number 4, modify the factory installed turbocharger with a special order kit designed to add 50 more horsepower to the engine performance. Well, does that increase the value of the vehicle? Does it give it something more than what it had initially? And since the answer to that is yes, that would be a capital expenditure. The next 3 items all say they replaced something, replaced a headlight, a shock absorber, and fog and cab light bulbs. All of those are items that are routine maintenance. They're restoring it to its original condition, but not improving the lifespan of the vehicle, not improving over the initial value of the vehicle. Number 8, replace the hydraulic brake system that had begun to fail during his latest trip through the Rocky Mountains. That is something that's a big enough expense that it probably does extend the actual useful life of that vehicle. So this is a little bit more of a judgment call, but I'm going to assume that because the hydraulic brake system, of course, is a very expensive situation. And so there'd be more of an incentive to add that to the balance sheet. or capitalize that expenditure. So this isn't the same thing as just replacing brake pads or rotors that we're wearing out. This is a much bigger deal. Remove the old radio and replace it with a new communications module. And reading between the lines, it sounds like they're saying this is an upgrade or an improvement. A betterment is another term we use to describe that. And so because it does make the truck have a better value than it had before, removing a radio and including a new communications module, that sounds like an improvement or a betterment. And finally, replace the old radar detector with a newer model that is fastened to the truck with a locking device that prevents its removal. So again, it sounds like this is an upgrade to the original equipment, and it is installed. They've made that very clear that it cannot be removed. And so it is part of the truck and an upgrade on what was there before. And so that would be a capital expenditure as well. So why do we just spend 10 minutes talking about this concept? Why do we spend so much time on this? Because it makes a difference to the company. It is a better situation generally from the viewpoint of analyzing their financial statements. It looks better if we can record something as an asset rather than expense in that same period, if we can write off those capital expenditures over time. Now, we did talk about last class the impact on your taxes. And so just a reminder, how we treat things for tax purposes can be different than how we treat them for financial accounting purposes. So just because we put something on our balance sheet on our financial accounting records does not mean that we can't expense it on our taxes. And of course, from a tax standpoint, it is better if we can write it off more quickly. Any questions about that? Should put in my green check marks. Any questions about that exercise? Okay. So I had told you last class, I'm going to shrink this down. The way I described this last class was we were going to go through the entire life cycle of a fixed asset. So we started with how do we decide we're even going to buy an asset? Well, we decide that based on whether it's going to add value to our company, whether it's a good financial decision. And I told you that when we get to chapter 11, we talk about that a little bit more. So how do we know if it's a good financial decision for us? But once we make that decision to acquire a new long-term asset, we looked at how do we record the acquisition of that asset? How do we record depreciation over its useful life? What happens if something changes? And now we are at the end of the useful life of that asset and we are going to dispose of it. We're going to get rid of it. And this will be our last exercise that relates to those fixed assets or property, plant, and equipment. One second. Okay. So the first part of this exercise, part A and B, will be review from what we did last week. So this will be a good chance for us to revisit some of those terms. Remember, in the reference materials folder for this chapter, there is a page of terms and formulas that will be helpful for you. So if you need to look at those right now, you're welcome to do that. I won't be copying them over into Cengage as I did last class because we've already done this. Equipment acquired on January 6th, so they're helping us out again, first half of the first month of the year. Clearly that doesn't happen all the time, but it does make our calculations simpler. We saw in exercise 4 what we would need to do if if the asset was not put into service in the first half of the first month of the year, that we would simply record a partial year depreciation. The equipment cost $375,000. So you should be familiar with what costs went into that. Maybe if there were any transportation fees or special taxes, installation fees, setup charges, any special training that was required before we could start using that equipment. All of those costs makes up that $375,000. We know that there are two items or two quantities we have to estimate. The first one is how long are we going to use this asset? And we estimated that to be 20 years. And the second estimate, which is related to that first estimate, how much is it going to be worth? The residual value, salvage value, scrap value, trade-in value, all those terms kind of mean the same thing. So how much do we think it's going to be worth at the end of that period? $25,000. Get my annotate function up here. And so we can already calculate the depreciable cost. Oops, I want that to be in red. So the depreciable cost, the value of that asset that we are going to use up and therefore needs to be recorded as expense over the useful life of this asset is $350,000. So over the 20 years that we're going to use this asset, we are going to record a total of $350,000 in depreciation expense. The difference between the various methods for recording depreciation is how we split that up. We are asked in this exercise to use the straight line method, which is of course the easiest of the three methods because it's the same every year. And so to use the straight line method, the depreciation calculation is the depreciable cost, $350,000 that we just calculated, divided by the estimated useful life. And we find that the depreciation would be $17,500 per year. So that should be familiar to you because we did that last class. And each of the first 3 years, we record $17,500 worth of depreciation expense. And on our balance sheet, at the end of the third year, or at the beginning of the fourth year, same thing, ending balance of 1 year becomes the beginning balance of the next year. On our balance sheet, if we could see enough detail, this is what we would see. Equipment, originally costing $375,000. Abbreviating a little bit there. The accumulated depreciation, $17,500 a year for 3 years. It's $52,500. And then the term that the book uses more frequently is book value. What do our books or our records, what does our balance sheet show that's worth? But you're just as likely to hear the term carrying value. How much are we carrying that asset for on our balance sheet? And so if we could see enough detail on this company's balance sheet, this is what we would see. The original cost, $375,000. How much of that we have used up or recorded as expense, $52,500. And then the difference is the book or the carrying value, which is our answer to part B. So I need to point out at this point, if you didn't hear me say this last class, that $322,500 is not, and it's not intended to be, the fair market value of that equipment. depreciation is not an effort for us to match the value of the asset in the real world. You know, if we were to try to go sell it, we call that fair market value or FMV. Depreciation is not an attempt to show that asset at its fair market value on our balance sheet. Instead, it is the accounting technique that we use to take the upfront cost, the part that we're going to use up of this asset, which we calculated right here to be $350,000, and spread that depreciation cost over the whole period, the whole time that we are going to use that asset, in this case, 20 years. So at any given time, the asset on our balance sheet may be, what we show on our balance sheet may be more or less, or purely coincidentally, exactly the same as what that asset is actually worth in the real world if we were to try to sell it. There are 2 points where we believe what our balance sheet shows is what the asset is worth. The first one is when we buy it, because we know that that's what we paid for it. So that's a reasonable to say that's how much it's worth. I hope we paid what it's worth, right? So when we buy it and put it on our balance sheet, at that point, it's worth what we paid for it. And we expect, because that's our estimated residual value, we expect 20 years from now, when we finish using the asset, it will be worth the $25,000 that our balance sheet shows it will be worth. But that's an estimate, so we could be wrong. Even if we use it for the full 20 years, how much we thought it would be worth, 25,000 in this case, may not be how much it's worth. It could be worth more than that, could be worth less than that. It might be we have to just throw it away as having no value. It might be we have to pay someone to take it from us because it's some kind of a hazardous material. I don't know. Okay, so hopefully you get that. The book value, the reason we call it the book value is that may not be its actual FMV or fair market value. Any questions at this point? Okay. So we scroll down. So we know as of January 1st of year 4, and we planned, remember when we bought it, we planned to use it for 20 years, but sometimes that might change. Maybe we change the direction our company's going. We don't need that piece of equipment anymore. Maybe there's a new version of this equipment that's out, the latest and greatest, and we want to trade this in and get a new one because it's going to make our work more efficient or more profitable or less costly or something like that. It could be then, even though we intended to use it for 20 years, that we use it for less than that. And what we're told in parts C and D is, okay, what if we sell it at the beginning of year 4? And it's fine for us to do that. Just because we thought we would use it for 20 years, doesn't mean we have to use it for 20 years. In this case, we sold it in year 4. It could be that we use it for 27 years because it just held up and there's nothing else out there that's better, or we can't afford to buy a new piece of equipment right now, something. If we do sell it, as I already said, we could sell it for more or less than our books say it's worth. And those are the 2 situations we're going to see here in C and in D. In C, it says we sell it for $300,000, but our books say it's worth $322,500. And in D, it says we sell it for $325,000, which is more than our books say it's worth. So we're going to see both situations. How do we record this, the sale of this asset? So part of this journal entry in both circumstances, whether we sell it for more or less than what our books say it's worth, part of the journal entry is going to be to record the cash that we received. I'm going to do these simultaneously so that you can see how they contrast with each other. So part of the entry is going to be to record the receipt of cash. That part always has to happen. We always have to show exactly the cash we spend or receive. We don't ever adjust cash, remember? Now I erased it from the screen, but I had showed you what it would look like on our balance sheet, where we have the equipment valued at what we paid for it, $375,000. When we sell this equipment, we need to remove the equipment from our balance sheet because we don't have it anymore. And so both entries are going to include a credit to the equipment account for what we paid for it, because that's what's in there. We need to remove it from our balance sheet. We don't have it anymore. If you're wondering, how did I know to put the equipment on line 4 for Part C and on line 3 for Part D? I only know that because I know that's where the book put them. There's really not a correct line between those two. But the requirement is that the debited accounts go first and then the credited accounts. So since I knew we needed to credit equipment, when we bought that asset, we debited the equipment account. To clear it off our books, we need to credit the account. So this could easily have been the equipment on this line, and it actually surprises me that they gave us that option of putting it on that line. And I'm guessing they probably don't have, so equipment isn't even a choice here. Okay. So that's going to look the same. Now, the other thing that I had on the screen, and I said this would appear on the balance sheet for this company, was the accumulated depreciation with a total value of $52,500. Well, we know that accumulated depreciation is a contra asset account, so it has a normal credit balance. If we're taking the equipment off our balance sheet, we also need to wipe out the accumulated depreciation on that equipment. Since it has a credit balance, we need to debit that account to get it off our books. And so that line also looks the same, regardless of whether we sold it at for more or less than what we paid for it. Or excuse me, more or less than what our books say it's worth. If we had sold it for exactly what our book said it was worth, the entry would still look exactly the same, except the entry for cash would be, don't change yours because this is not correct. The entry to cash would be $322,500 if we sold it for exactly what our book said it was worth. So the entry so far, other than the amount of cash, is really exactly the same. We have a debit to cash for what we received, and we have a debit to accumulated depreciation to remove all the depreciation that has been recorded, and a credit to equipment to remove the original or historical cost of that equipment. Now we know we can't be done, and because we use these templates, there's an easy way for us to know we can't be done because we've got this blank line in there, so that's not going to happen. But we also, there's another way from an accounting standpoint we can know we can't be done, because the debits in total do not match the credits. And so for Part C, let's figure out how far off are they. So we have credits of $375,000. We have one debit for $300,000 and another debit for $52,500. So we are off from being balanced. We are off by $22,500. We need a debit of $22,500 to make this balance. So what happened here? In Part C, we sold that equipment for less than our book said it was worth. Clearly, our books were overstating the value. Is that a problem? No, because we still have reason to believe that our depreciation would have worked out if we'd kept it for the 20 years. Really, the reason that our books have an inflated value, 322.5, is because we didn't record enough depreciation during the time we were using that asset. It depreciated more quickly than straight line depreciation would have had us believe. That is a loss. The title of the account that we use there is loss on sale of equipment. What we are doing, you'll notice that it has a debit balance. That loss looks just like an expense. It shows up on our income statement and it reduces our income the year that we sold the equipment. We did not record enough depreciation in the first 3 years. And so we're making up for that. That loss reduces our income. And really what we are reflecting is that 22,500 is additional depreciation we should have been recording in those first 3 years. But we didn't know we were going to sell it in year 4. Again, it's not that our depreciation calculation was bad or wrong, certainly not unethical, but it just wasn't exact because it was based on 2 estimates: how long we'd use it and how much it would be worth at the end of that time. And those estimates weren't perfect. We only used it for 3 years instead of 20. Everyone good so far? Does that make sense? Okay. Let's look at part D then. In part D, if we add up the 2 debits, you'll see that those 2 debits in total are more than the 1 credit. We sold the equipment for more than our book said it was worth. $2,500 more. So we need $2,500 on the credit side to make this entry balance. Debits and credits must be equal in total. So what does that $2,500 represent? It's a gain. That gain looks like a revenue that has a credit balance. It's going to show up on our income statement. It's going to increase our income the year that we sell this equipment in year 4. Why? Because we now know that since we sold it in year 4, we actually recorded too much depreciation during the first 3 years that we used that asset. And so we're recouping some of that. We're getting it back. We already recorded the expense in the first 3 years, and it was too much. So now we're getting some of it back. We're going to record that as a gain on the income statement, and that increases our income just like a revenue would. Whoops. I just wanted to close the door. There's some talking in the hallway. So, any questions about that? Okay, so when we sell equipment, it could be that we sell it at a gain or at a loss or at exactly its book value. And we've seen how to record any one of those. If we had to just throw the asset away, as having no value, the cash line, of course, would not be included. And so we would just have to balance the entry. We'd still have the accumulated depreciation debit and the equipment credit, and we'd have either a loss or a gain. Well, I guess it would have to be a loss in that case if we threw it out, unless our book said it had no value to begin with. That would be referred to as a fully depreciated asset, and that can happen. If we start out with the assumption that it will have no residual value at the end of its life, and then we use it for the whole time, it will have no value. And when we throw it out, we simply need to get it off our books. Okay. Any questions on this? One other comment. Again, they made it easy for us by saying we sold it on January 3rd. So again, that was in the first half of the first month of the year. If we had sold it anytime after January 15th, we would record, before we did this entry, we would record a partial year depreciation for however long we had it for that year. So we would just do a standard depreciation entry for the partial year, as we saw how to do in exercise 4. And then we would do the same kind of entry. All right. Questions, anybody? I'm going to go back to my PowerPoint now. Scroll down here a little bit. Okay. So I told you last week when we started this chapter that the bulk of the chapter would be focused on those fixed assets or property, plant, and equipment. But that there would be 2 other categories of long-term assets that we would discuss very briefly at the end of the chapter, and that's where we are now. So our next exercise is on depletion, and that relates to natural resources. So you can see here on the screen, some businesses own natural resources such as timber, minerals, or oil. So these are products of the land. They could be under the land or something that grows on top of the land, such as timber. If the business owns the timber or mineral rights to a piece of property, but that's not the business they're in. If they are, it just happens that they own some property that happens to be next to their factory where they make widgets. If they aren't in the business of harvesting those natural resources and selling them themselves, those assets would not be considered the same way on their balance sheet. Instead, they would be considered as investments. So if it just happens that you own the timber rights to a tract of land and you sell those rights, you allow a timber company to come in and harvest the mature trees or whatever, then those would be considered an investment for you. So what we're talking about here specifically is a company that owns those natural resources and uses them, harvests them, and sells them as part of their normal course of operations. It's what they're in business to do. You can see the description here of what makes something a natural resource. It's naturally occurring. We are going to remove it for sale, and it's removed and sold over more than 1 year. For that reason, it is a fixed asset for us because they're going to be removed and sold over more than 1 year. So this would not include that company that that acquires the rights to remove timber on a tract of land, and they just go in and remove the timber in that same year that they acquire them. It would not show up in the same fashion on their balance sheet or their income statement. The cost of the natural resource includes the cost of obtaining and preparing it for use. So all of the costs of harvesting it, of cutting it down, of mining it, or whatever else needs to happen to acquire that asset. And really, the calculation, here's an important term for you. I'm going to highlight this. We call, when we use a natural resource and we're recording the expense associated with that, we call that depletion, depleting the natural resource. And that word means the same thing for a natural resource, has the same relation to a natural resource as depreciation does for a fixed asset such as property, plant, and equipment. So depletion is the gradual writing off or recording of expense. The calculation of depletion looks very much like what we call the production method or units of activity method of depreciation. We take the total cost of that resource and divide it by the estimated total units. So rather than using some units of time, we are using, whether it's board feet of lumber or ounces of the minerals or whatever, however much we think is there and recoverable. So when you think about maybe the rights to natural gas or to oil, those rights are going to be based on how much, not what's there in total, but how much can we get out. So there may be some deposits that are just not cost effective for us to try to extract. And if that's the case, we're not going to count those units that we might believe to be there, but we can't get to using the current methods that we use. This depletion rate can be calculated upfront when we acquire the rights to those assets, just like we could for the activity method or the production method in depreciation. And then each time period, as we are extracting and selling that asset, we are going to take that depletion rate and multiply by the amount that we extracted or harvested. And we'll see that in our next exercise. I'm going to stop here with the PowerPoint. We don't need to go through the example in the PowerPoint. We're going to go to our own example. If I can get my computer to cooperate with me. We'll go to exercise 8 for our own example of calculating and recording depletion. Alaska Mining Company acquired mineral rights for $67,500,000. The mineral deposit is estimated at 30 million tons. It might turn out to be somewhat more or somewhat less than that, but we have to estimate. And of course, we're going to be, in this case, we'd be consulting a geologist, right, to give us that estimate. How much do you think is there? We would be doing this calculation. The calculation I'm going to do first, we would do this before we even acquire the rights, because we're going to decide, is it worth it for us? We have to know how much is it going to cost us per ton. And then we compare that to how much we think we can sell it for to decide if it's worth it. So we'll start with the calculation of depletion expense. And again, this part would be done before we even agree to buy the property. We have to know, is it worth it? So we have our own experts come in. I'm going to move this down, a little bit more room. So we have our experts come in and tell us how many tons they think is there. Of course, the company that sold us the rights have their own opinion or estimates of how much is there. And we calculate the cost. We estimate that the cost is going to be $2.25 per ton. $2.25 per ton. And then we, Alaska Mining Company, look at that and say, I don't know, is it worth $2.25? How much can we get for it? How much do we think it might be worth in the future? So we're doing some speculating about whether we should go ahead and acquire these or not. And we decided, yes, it's worth it. So we buy the mineral rights. And now we are going to start extracting that mineral. And as you saw, the requirement is that this is, in order to go on our balance sheet in the same way, it needs to be a long-term process, more than 1 year to extract this mineral. During the current year, which may or may not be the first year, it doesn't matter. During the current year, we mined and sold 4 million tons. And we already calculated the cost to be $2.25 per ton. So $2.25 per ton times 4 million tons. The depletion expense for the current year would be $9 million. That's $2.25 per ton times 4 million tons. How does this get into our records? Well, in letter B, we are asked to journalize the adjusting entry to recognize that depletion expense. Debit to the depletion expense and a credit to accumulated depletion. So that accumulated depreciate, oh my word, trying to combine the two words. That accumulated depletion is also a contra asset, just like accumulated depreciation. And when we look at our balance sheet, this company right now would show, get my text back up here. This is what would appear on this company's balance sheet. If this was the first year, natural resource or mineral rights or something like that, what they paid for them. And I'm going to assume that this is the first year because I don't have any information about any other years. And we record the accumulated depletion. And then the next line, just like for a property, plant, and equipment, would be the book value or carrying value. How much of that value is left? Oops. And so just like with that long-term asset equipment, we can see how much we originally paid for it and how much of the value is left. Again, that depletion, just like depreciation, is based on an estimate. How much is there in total? How much are we going to be able to get out of the ground in this case? There's an important term here I want to point out to you. Right here. It says that the 4 million tons were mined and sold. That's a critical piece of information for us to have. It was mined and sold. If it was mined but not sold, the part that wasn't sold would be inventory for us. Okay, so we wouldn't record it as an expense until we actually sold it. If we have harvested it, but it's not sold yet, it would be inventory, a current asset for us. It's available for sale. We've already done the work. We've already extracted it from the ground, and now it's waiting to be sold. So as I told you last week, our coverage of natural resources is very minimal, just to help you recognize that, yes, there are natural resources out there. There are literally entire courses about accounting for lease rights and things like that when it comes to mining, drilling, that kind of thing. So there are a lot of intricacies to that we are not making any attempt to cover in this class. It's really just to help you see, yes, these are other considerations. Most companies, of course, are not involved in harvesting natural resources. And so, as you know, we focus in this class on the types of accounting situations that most companies would face or would see. Any questions, though, about this exercise? Okay, so it looks just like the units of activity method that we covered for depreciation. The key being that it was both extracted and sold in the same period in order for the expense to be recorded all in that same period. And we'll move on. If there aren't any questions. other category of long-term assets or fixed assets that I said we would cover in this chapter is intangible assets. So I used the term last week when we were talking about the property, plant, and equipment. I said those are tangible assets. There's something that have a physical substance to them. You can touch them, you can see them. This last category for this chapter is intangible assets, which means that they don't have a physical substance to them. They aren't something you can touch. That's what the word intangible means, not touchable. So intangible assets are more intellectual property, if that term helps you to recognize what these are. And you can see some examples there: patents, copyrights, trademarks, goodwill. Intangible assets, in order to go onto the balance sheet, must be purchased from some outside entity. So let's use the example of a patent. A patent, as you may know, is a legal right to a process. So you've developed a process for making something, for doing something. And you get a patent on that issued by the US Patent Office that says you and only you or your licensees, your designees, can use that process. It's a legal protection so that others don't infringe on your patent or use that same process that you spent all that money developing. If it's developed internally, though, we don't know the value of that patent. Because by definition, research and development, or R&D, research and development costs under GAAP, under generally accepted accounting principles, are expensed in the period in which they're incurred. I'm just going to say expensed immediately. When we spend money, so think about over the last 2 years in COVID, and the pharmaceuticals companies, not just the ones who ended up with a product for sale, but all of the other companies that were spending money trying to develop immunizations or treatments for COVID-19. And the vast majority of them did not end up with a product that they could sell, either because it didn't work or because it wasn't approved or wasn't approved in time. And so because the outcome of R&D expenditures is uncertain, because when we spend the money on R&D, we don't know if we're ever going to end up with a product that we can sell and make money on. The rule is we can't put those costs for R&D on our balance sheet because we don't know at the time we're spending that money whether we'll ever actually have an asset, something that we can use to make money for the company. And in reality, the vast majority of R&D expenditures do not result in a product that can be sold. So if all of those companies that were spending money had put it on their balance sheet and then they don't end up with something they can sell, they're overstating the value of their company because they've got this big asset showing on their balance sheet that's not actually an asset for them, that can't help them to generate revenues because it never resulted in a product that they could sell. Do you follow that? Does that make sense? So if you see a patent on a company's balance sheet, it means that they acquired, as you can see here in this second bullet point, it means that they were acquired from some external source because otherwise there's no way of valuing them. If you see an intangible asset like a patent, a copyright, a trademark on a company's balance sheet, you know that they bought it from someone outside the company because that's the only way that they would have a verifiable dollar amount that that asset is worth. What that means is most companies, when you look at their financial statements, you're not going to see patents, copyrights, trademarks that are worth anywhere near what they're actually, what they actually have available to them. So before class, I was looking at the Microsoft balance sheet with a student, and there was a small category, small by Microsoft standards, a small category called intangible assets, and that's where their patents, copyrights, trademarks would be included, but only the ones that they acquired by buying up another company or buying the patent outright from another company. Everything that's developed internally has already been expensed, written off as an expense on their income statement. But in those cases where we do have intangible assets, patents, copyrights, trademarks, goodwill, franchises, anything like that, if you do have it on the balance sheet, there is a chance that we need to record expense associated with that over time. Again, they're fixed assets because, or they're in the long term, not fixed, they're in long-term assets because we expect to use them for more than 1 year. Some of those long-term assets are going to lose value over time, and some are not. Some of those assets, such as copyrights, and patents, have a limited legal life. So a copyright eventually expires, a patent eventually expires. So for those assets that have a limited legal life, we have to write off that cost over time. And the maximum amount of time that we can write it off is the legal life. So if the patent is for, and I don't know, not a lawyer, obviously. If the patent is going to be good for another 20 years, let's say, then we need to write off that expense over those 20 years, if not a shorter period of time. The maximum time is the 20-year legal life. If we think the patent's only going to be good, that is, people are only going to want to buy it for 5 years, then we would need to write off that expense over 5 years. Same thing is true for copyrights. Copyrights are decades long. But you guys are all college students, so you probably have a sense that most college textbooks are out of date within a few years, 3-4 years on average. And some even more frequently than that. So the tax class that I teach, there's a new textbook every year because guess what? Tax law changes every year. So I could have copies of my income tax fundamentals textbook for the last 10 years. But at the end of every year, they go in the recycle because when the new one comes out, when the tax law changes, the old one's no longer any good. So for that company producing that textbook, yes, their copyright on the income tax fundamentals from 2019 is still good, but nobody's going to buy it. And so they would have to expense that cost every year because it's only going to be good for 1 year. Does that make sense? Make sense? Okay. So we already saw in the first part of the chapter that depreciation is the term we use for gradually writing off the expense of property, plant, and equipment. And we just saw in the last exercise, depletion is the term for writing off the cost of a natural resource over a period of time. We have one more word here, and it's right here in bold in the middle of the page. Amortization is the word we use to describe the writing off of the value of an intangible asset. We will see that word in one more chapter after this, and that's in chapter 11 when we talk about corporate bonds. But amortization is really the same concept as depreciation and depletion. It's the gradual writing off of the upfront cost of some long-term asset. Depreciation is for property, plant, and equipment. Depletion is for natural resources. Amortization is for intangible assets. Some intangible assets may never have amortization recorded on them. Trademarks are good forever. They don't expire. And so the only time you would record an expense related to a trademark is if that value became impaired. So something happened to reduce the value of that trademark. Maybe it was a scandal or a lawsuit or something like that, that people no longer had the same respect or interest in that trademark. And then you might need to record some amortization or some expense associated with the loss of value, or impairment is the accounting term we use, impairment of value of that trademark. Okay. When we buy a patent, the cost of acquiring that patent becomes part of the cost of the patent itself. So we might pay $1 million for the patent, but we have to pay the attorneys another $10,000. The value of that patent to us would be $1,010,000. As I already pointed out, because a patent has a limited legal life, at most, we need to write off that value over the expected useful life, the legal life of the asset. If we think the expected useful life is shorter than that, we're going to write it off over a shorter period of time. Normally, we're going to use straight line when we're talking about amortizing patents or other intangible assets that gradually lose value over time, like a copyright. Now, for depreciation and for depletion, we had that contra asset account, but you'll notice in the second bullet point here, the last sentence, we don't normally use a contra asset account for recording accumulated amortization. Instead, we reduce the value of that asset directly on the balance sheet. So it is true for intangible assets that usually you cannot see the full upfront value or the original value. You can only see the value that is remaining, unlike for our the fixed assets of property, plant, and equipment and natural resources. And let's go to our exercise. So exercise 9 deals with a patent. Clean Company acquired patent rights on January 10th, again, conveniently within the first half of the first month of the year. They paid $2,800,000 for it. So now we know how much it's worth because that's how much we paid for it. We're going to put it on our balance sheet at $2,800,000. And that entry would look like this. Excuse me. Let me put it down here to make sure I don't infringe on that space. So when we acquire the patent, and I'm going to pretend we paid cash for it. It doesn't really tell us that, but we'll pretend. Doesn't really change anything, even if we took out a loan for it or something else. Okay, so that would look like this when we acquire the patent. We've exchanged one asset, cash, for another asset, that patent. Now, well, let's take it in chronological order here. So we acquired the patent rights for $2.8 million. The patent had a useful life equal to its legal life of 8 years. If we thought we could only sell whatever this patent was for, if we thought we could only sell it for 4 years, we'd need to write it off over 4 years. If it was 5 years, even if the legal life is 20 years, if we think we can only sell it for 5 years, we need to write it off over 5 years because of the matching principle. Because we want to make sure that we are recording all of the expense at the same time we're recording the revenues. If we think those revenues are only going to come in for 5 years, that's all we should record the expense. Okay, so determine the patent amortization expense for year 4. Well, let's do years 1 through 3 first, just to see what that would look like. So we acquired the patent for $2,800,000. We expected to use it for 8 years. And so at the time we acquired the patent, we planned to record amortization of $350,000 a year for each of the 8 years that we used the patent. And so in the first 3 years, how much amortization did we record in total? $1,050,000. And so at the end of year 3, how much was that patent worth? Well, it had an original value of $2,800,000, but we have already recorded it as expense or written off, amortized $1,050,000. And so the remaining value is $1,750,000 at the beginning of year 4. Everyone agree with that? Okay with where that came from? It's just like straight line depreciation. Now what happens? We are told at the beginning of year 4, first half of the first month, again, conveniently, Clean successfully defended the patent in a lawsuit at a cost of $38,000. What does that mean? Well, the whole reason that this patent is valuable is because we own the exclusive rights to whatever this process is. Nobody else has a legal right to use it. Regardless of where you are in the political spectrum, regardless of what you think about government intervention in the markets, most people, regardless of who you are, when you talk about economics, most people believe that one legitimate function of government in the market is to establish the legal framework to protect intellectual property. And so what happened here? Someone, some other company, some other entity was infringing on Clean's patent. In other words, they were using that process that they did not have a legal right to use because Clean owns the patent and did not give them permission to use it. So they sued them. They said, you can't do that. They probably tried to do it, kindly, less expensively at first, and sent them a letter, probably from their attorneys, a cease and desist kind of letter that says, you can't do that. We saw what you're doing. That's not acceptable. Stop or else. And it didn't stop. And so they sued them. They took them to court. It cost them $38,000 in legal fees, but their defense of the patent was successful, and the other company had to stop doing what they were doing. Now, if you ask me, something fell apart here because the other company should have had to pay the legal fees for Clean, but that's not what we're told. So we're going to go with this. It helps us with our accounting example. But in the real world, I hope that if this was a true story, that Clean actually included in their settlement that the other company, the infringing company, would need to cover their legal fees. Again, that's not what we're told. So we're going to go with the information we have here, because otherwise we will get the answer wrong. They just want you to be thinking about, does that really make sense? That they really have to pay for that? In a perfect world, no. The other company would have to pay their legal fees as well because they were successful. But because they did, in our example, have to pay those legal fees become part of the cost of the patent. At the end of year 3, beginning of year 4, the value of the patent was $1,750,000 because we'd recorded 3 years of straight line amortization. And now that's going to jump up by $38,000. And so as soon as we settle that lawsuit, and it cost us $38,000, we're going to add those costs to the value of the patent on our balance sheet. And it's now showing that it's worth $1,788,000. We've already used it for 3 years. The estimated useful life originally was 8 years. So we have 5 years of time left that we expect to use that patent, right? So we're going to continue straight line depreciation. Or not depreciation, excuse me. Straight line amortization of that patent expense. Our original amortization was $350,000. But now we have another $38,000 that we need to spread out over the next 5 years. So that jumped our depreciation for year 4 through 8. Year 4 through 8, the depreciation, wow, I keep saying that. The amortization that we need to record is $357,600. It's gone up by $7,600, so that over the next 5 years, we will have spread that $38,000 in legal expense in addition to the upfront cost of the patent. Make sense? Last part then, journalize the adjusting entry on December 31st of year 4 to recognize that amortization that we just calculated. So we know we're going to be debiting something and crediting something else. The debit, of course, is going to be to the expense. It's going to show up on our income statement. As we discussed for intangible assets, we don't typically use a contra asset account. Now, the fact that we don't typically use it means that some companies could choose to use that. But our approach will be to credit directly to the asset itself. And so the credit, rather than being to accumulated amortization on the patents, is to the patents account directly. And so each year, as we record that expense, the value of the patent on our balance sheet comes down. And we can't see on our balance sheet, we aren't going to see after year 1, this value for the patent. It comes down incrementally each year as we use it. Questions on that? Okay. So as I said, some other long-term assets, intangible assets, don't automatically lose value over time like a patent or a copyright that has a defined legal life, has a limited life. Some assets like trademarks, we don't automatically record amortization annually. Instead, they do what's called a check for impairment. And so at least on an annual basis, they're going to look at, well, let's take a look at our trademarks. Do we still think they're worth what they were worth before? Now remember, they're only going to be on their balance sheet if they were acquired from an external source in the first place. And so many companies, where their most valuable asset might be their trademark, it may not show up on their balance sheet at all if it was developed internally. And so if they have trademarks or other long-term assets that do not have a limited legal life, each year at a minimum, they're going to look at that and say, is it still worth that? If it's still worth the same, or if they think it's worth more, we just leave it alone. So we don't ever increase the value over what we paid for it. But if we look at that value on the balance sheet and say, you know, that lawsuit we had last year really gave us a black eye, and so that that trademark isn't as well respected, isn't as valuable for us now. At that point, they would need to reduce the value. It's called impairment. They would need to write off some of that value. And companies want to be really careful doing that, because once they say, yeah, it's impaired, and they reduce the value on their balance sheet, they can never bump it back up. They can't 2 years later say, oh yeah, you remember that lawsuit? Nobody else remembers it either. Now we get to move our trademark back up to where it was before. They can't do that. Once it's, and that's the conservatism principle. Once they reduce the value on their balance sheet, they just need to leave it alone. Okay. Any questions before we move on to our final exercise for this chapter? Book value of fixed assets. Now, we've already talked about this. I've been showing you in a couple exercises, even today, what would be showing on the company's financial statements. And so you can see, and this is for Apple. I'm not going to read you the whole introduction. Everybody knows what Apple is, right? So this is taken from Apple's balance sheet for their fixed assets, long-term assets, property, plant, and equipment. And you can see 1 year and then the previous year. The dollar amounts that you see here represent historical cost. It's what we paid for those land and buildings, machinery, equipment, and internal use software, and then other fixed assets. And this amount represents the accumulated depreciation and amortization on those fixed assets. So they've added together the depreciation and amortization for each one of those three categories. So we are asked to compute the book value of the fixed assets for the current year. So we'll do that together. The current year, the book value is going to be the original cost, $10,185 plus $44,543 plus $6,517. The original cost or historical cost of those assets, adding all three categories together, is $61,245. That's millions of dollars, so it's $61 billion. And from that, we subtract the accumulated depreciation and amortization. And so for the current year, the book value, what shows up on their balance sheet as the net amount, is $27,010 million. $27,010 million. Go ahead and find that amount for the preceding year. I'll let you do that on your own. Everybody okay with those? A comparison of the book values of the current and preceding years indicates that they increased from 22 to 20, rounding, 22 to $27 billion. A comparison of the total cost and accumulated depreciation reveals that Apple purchased how much? So we're going to assume they didn't sell any. Okay, we're going to assume they didn't sell any. It doesn't tell us that, but we have to make that assumption, because there's no way from looking at this, if they had sold any of their fixed assets, that we could do these calculations. So on net, how much additional did they purchase? Well, their historical cost went from 49,257 up to 61,245. How did that happen? We bought additional assets that cost 11,988,000,000. It's the difference between the original cost from last year, 49,257, and the new historical cost for this year, 61,245 minus 49,257, which was offset by the additional depreciation expense of, so our depreciation went from 26 up to 34. So what's the difference? How much more depreciation did we record this year? The accumulated depreciation and amortization went from 26,786 up to 34,235. The difference is $7,449,000,000 in depreciation and amortization recorded this year. Would you normally expect Apple's book value of fixed assets to increase or decrease during the year? Are they a growing company? So normally you would expect it to increase. Okay, so that is the end of our exercises for chapter 9. Any questions at this point? Okay, I'd like to take the last 7 minutes. If you have questions, of course, I'll be happy to answer them. But if there aren't any questions, I would like to take the last 7 minutes and just take a look at the annual report project, part 3, and just see what it is you need to do for that project. Okay. So you'll notice that, oops, making it too big, sorry. Come on. There we go. You'll notice that for chapter 7, there are 2 parts because all the questions just wouldn't fit on one snip. I think it was 2 separate pages maybe in the textbook. For part 8, again, there are two snips. And then part 9, there's just 1. Make sure you answer all of the questions. It is easiest for me to see that you answered the questions if you just follow the numbering pattern that's here, right? Chapter 7, question 1, A, B, question 2, A, B. You don't have, C, D, sorry. You don't have to answer in complete sentences. If you follow the numbering pattern that's here in the questions, I can easily see what you're answering. So how much cash does the company have? What percent of total current assets is cash? So make sure you're paying attention to those terms. So this asks for percentage of total current assets. So you should be able to find that. That's not your total assets, it's the total current assets, cash, inventory, receivables, and so on. You'll have to do that calculation for 2 years so that you can say whether it has increased, decreased, or remained the same from last year to this year. Okay, so you're going to find that information right on the company's balance sheet. I had someone ask me last night, someone who's working on the project in the online class, and she was saying that some of the information she needed for the project was not showing up on their 10K. So the instructions tell you to find their 10K on the SEC's website. I would strongly recommend, though, that what you do is go to the company's website and pull up their full annual report, because it does give you additional information that is not included on the 10K. Actually, that student was not in this class, she was in the other class. And so you're better off to go directly to the source, which is your company. That's where you're going to find this management's annual report on internal control. You're not going to necessarily find that in their 10K. So you're going to talk about internal controls in that section 404 that we spent time talking about from Sarbanes-Oxley. In chapter 8, again, you're going to be going to their balance sheet to look at their accounts receivable. This balance in the company's allowance account probably does not show up, almost certainly does not show up on their balance sheet. So most companies on their balance sheet just show net accounts receivable. So it's the total amount that's due to them minus the part they don't think is collectible. So where are you going to find this? In the notes to the financial statements. So again, you're better off to be using the company's annual report to find that. Usually the very first note is about significant accounting policies, and you may be able to find the accounts receivable part there. If you don't find it there, just keep flipping through those pages. If you just read the headings, the bold-faced print, you will find one that refers to accounts receivable and specifically to uncollectible accounts. Again, pay attention where it says total current assets. That's not total assets. When you're looking at for expense, you may find that on their income statement, but more likely than not, you're going to need to find that in the notes to the financial statements where it talks about write-offs or bad debt, uncollectible expense that was written off that year. Chapter 9 that we just finished, it's going to be related to depreciation, depletion, amortization, those long-term assets. To find what depreciation method the company uses, you again have to go to the notes to their financial statements. You'll find depreciation expense on their income statement. You can tell the initial cost or the historical cost, and you know how to find the book value, that they should report that specifically. Your company may or may not have intangible assets. So what types, if any, does the company have on their balance sheet? Again, you may need to go to the notes to the financial statements. They may just, as Microsoft did, they just had a line that said intangible assets, didn't tell me at all what that was. But if you go to the notes to their financial statements, you will find a note that describes what their intangible assets are. And then question number 2 there, the final one for chapter 9, we talked about that. Does the book value reflect current market value? You should know the answer to that already without even looking at your company. Okay, so that's the annual report project for this, to go along with this exam. Before I stop recording, does anyone have any questions about chapter 9 or about the annual report project for this section of the course? All right, well, thank you all for being here, and I hope to see you on Wednesday when it's not quite so snowy outside.